Wall Street wants you to believe one thing above all else: that money is complicated, that wealth belongs to people in suits, that if you didn't study finance, didn't grow up rich, didn't have connections, then you were never meant to win. But the most dangerous people in financial history were never the loud ones. They weren't on TV. They didn't predict markets. They didn't time crashes. They followed rules so boring that Wall Street ignored them. This is the story of one such man, a farmer, not a hedge fund manager, not an economist, not an insider, and yet he quietly beat Wall Street at its own game. Not once, not with luck, but consistently, for decades. And he did it using one simple rule: a man nobody paid attention to. In America, farmers are invisible to financial media. They wake up early, work long days, deal with weather, debt, uncertainty, and rarely make headlines. This farmer lived exactly that life. He owned a modest piece of land. He grew crops, raised livestock, repaired his own equipment, and lived far away from financial centers. No Bloomberg terminals, no analysts calling him, no breaking news alerts. But every evening after the work was done, after the dirt was washed off his hands, he sat at a small wooden table, not with a phone, not with social media, with numbers, not market predictions, not charts, simple company reports. He didn't read them to get rich. He read them to understand ownership, and that difference changed everything. The rule that changed his life. The rule was simple, so simple that most people laughed when they heard it. Only buy what you would be happy owning if the stock market closed for 10 years. That was it. No leverage, no options, no trading, no shortcuts. If he couldn't understand how the business made money, he didn't buy it. If the company relied on hype, he didn't buy it. If profits were inconsistent, he didn't buy it. If debt was too high, he didn't buy it. He wanted businesses that could survive storms, just like a farm had to survive droughts, floods, and bad seasons. Because farmers understand one thing deeply: you don't harvest every day, you plant, you wait, you endure. Wall Street hates waiting. Why Wall Street lost, and he didn't. During bull markets, Wall Street looks brilliant. Everyone feels smart. Everyone wins. But markets don't stay calm. They crash, they panic, they shake out the weak. When markets fell, professionals panicked. They sold. They blamed the Fed. They blamed politics. They blamed timing. The farmer didn't, because his rule protected him from emotion. He didn't own stocks. He owned pieces of real businesses. Businesses that still sold food, still sold insurance, still sold everyday products. So when prices fell, he didn't see loss. He saw discounts. The silent advantage of boring people. Wall Street thrives on activity. Fees are generated by movement, by trading, by complexity. The farmer generated wealth through stillness. He reinvested dividends. He ignored noise. He never tried to be first. And slowly, something strange happened. While others jumped from trend to trend, his ownership compounded. Not linearly, exponentially. Most people underestimate how powerful boring consistency is, especially over decades. The farmer didn't become rich quickly, he became rich inevitably. The crashes that tested everyone. When the market crashed, experts screamed. Headlines predicted the end. Funds collapsed. Careers ended. The farmer kept buying. Not everything, only what met his rule. Strong balance sheets, real profits, products people used every day. He didn't catch bottoms. He didn't predict recoveries. He just stayed invested, and history rewarded him every single time. The difference between intelligence and discipline. Wall Street is full of intelligent people, but intelligence doesn't build wealth. Discipline does. The farmer didn't need to be smarter than analysts, he just needed to be more patient. While others chased returns, he let returns come to him. Slowly, relentlessly, year after year, when people finally noticed. Decades later, something strange happened. People began to notice. This quiet farmer had accumulated holdings in companies most professionals underestimated. Insurance firms, consumer staples, utilities, businesses Wall Street called boring, but boring businesses, held long enough, become unstoppable. His net worth quietly crossed levels that shocked everyone who discovered it. Not millions, much more. And that's when people asked the wrong question. How did he get lucky? He didn't. He followed a rule. Why this story matters today. Today's market is louder than ever. Crypto, AI, day trading, zero commission apps, influencers promising fast money. Everything is designed to make you impatient. But the farmer's rule still works. Because human behavior hasn't changed. Fear still destroys returns. Greed still ruins timing. And patience still compounds. Wall Street doesn't want you to know this. Because patient people don't generate fees. By the time people finally started noticing the farmer, he was already old. Not retired, rich in the way America imagines wealth. No yachts, no interviews, no luxury houses. He still lived simply, still woke up early, still walked his land. But behind that ordinary life was something extraordinary. Ownership. When numbers finally spoke louder than appearances, when financial journalists first stumbled upon his portfolio, they didn't believe it. They assumed a mistake, a data error, a reporting glitch. Because how could a farmer with no formal education in finance have built something that rivaled professionals who spent their entire lives inside markets? They ran the numbers again. Still true. Decades of disciplined ownership had turned modest investments into a financial fortress. Not through prediction, not through timing, through endurance. The hidden power Wall Street ignores. Wall Street teaches people to think in quarters, in earnings seasons, in short-term moves. The farmer thought in lifetimes. He understood something that almost no one else does. Markets reward patience disproportionately. Most investors quit right before compounding becomes meaningful. They sell after 5 years, 10 years, right when the curve is about to bend upward. The farmer never left. He stayed invested through recessions, crashes, bubbles, wars, inflation, scares, and political chaos. Because his rule didn't depend on the world behaving well. It depended on businesses surviving. And the businesses he owned didn't need perfection. They needed time. Why simplicity beats sophistication. Wall Street loves complexity, derivatives, structured products, leverage layered on leverage. The farmer avoided all of it. He believed complexity hides risk. Simplicity reveals it. If he couldn't explain how money moved from customer to company to shareholder in plain language, he walked away. No exceptions. This filtered out 99% of opportunities. And that was the point. Most people lose money because they try to do too much. The farmer won because he did less. The discipline most people can't handle. Here's the part nobody likes hearing. The farmer's rule wasn't hard to understand. It was hard to live with. He watched neighbors get rich quickly. He watched friends brag about hot stocks. He watched bubbles inflate and people double money overnight. And he did nothing. No chasing, no envy, no reaction. Because discipline means watching others win temporarily without abandoning your process. That's a psychological pain most people can't tolerate. Wall Street exploits that weakness. The farmer ignored it. The moment the truth became undeniable, eventually, the truth surfaced publicly. When analysts compared long-term returns, his performance quietly crushed most funds, not because he beat the market every year, but because he never blew himself up. Professionals lost money during crashes, lost capital they never recovered. The farmer never did. Avoiding catastrophic loss mattered more than chasing maximum gain. That one insight alone separated him from almost everyone else. What his wealth really represented. His wealth wasn't proof of genius, it was proof of restraint. Restraint from trading, restraint from noise, restraint from ego. He didn't try to look smart, he tried to stay solvent. And solvency, over time, turns into dominance. Why almost no one can copy him. People hear his story and say, "I'll do that." They won't, because his rule demands something modern markets punish. Stillness. Doing nothing while everyone else is doing something feels like failure until years pass. Then it looks like brilliance. Most people quit too early. Change rules midway. Chase returns when boredom sets in. The farmer never changed the rule, not once. The final lesson Wall Street will never teach. The greatest advantage in markets is not information, not intelligence, not access, it's temperament. The farmer didn't beat Wall Street by being smarter. He beat it by being calmer, by refusing to participate in the emotional cycles that destroy capital, fear, greed, urgency, regret. He stepped outside that loop, and once you step outside, the game changes. How the story ends. The farmer passed away quietly. No headlines, no breaking news, but what he left behind rewrote assumptions that you don't need speed to win, that you don't need complexity to succeed, that you don't need Wall Street's permission to build wealth. Just one rule, followed relentlessly. For long enough, why this story matters for you. Because markets will always change. Technology will evolve. Narratives will shift. Assets will rise and fall. But human behavior stays the same. People will panic. People will chase. People will overreact. And quietly, the patient will inherit the results. Not immediately, but inevitably. Wall Street wants you distracted, impatient, reactive. The farmer won by being none of those things. And that's why his story is dangerous. Because once you understand it, you realize the game was never rigged against intelligence. It was rigged against impatience. Thanks for watching Finance Unmasked, where the loud myths of money are stripped away and the quiet truths are finally revealed.